Okay, so we're at kind of a weird point in time in the market right now. It's been a downturn, no secret about that. Last 2 years have been a really rough time. If you're a broker, you're at capital markets, perhaps you are a loan broker, it's been pretty rough, right? Interest rates have risen dramatically over the last now 2.5 years, I would say. Federal Reserve was tightening, and now we've begun our loosening campaign. If you watched our most recent videos, sigh of relief, right? Well, it's not quite that simple, unfortunately. So despite the Fed lowering interest rates, what happened after they did that? The 10-year has gone up. Oh no. Why? That doesn't make any sense. Everybody told us we were going to be getting lower interest rates, that the good times were coming back, we were going to be able to go out and buy stuff like pandemic rates in the 2.5% ranges. Well, not really, but you get the idea. That's what everybody wants, right? Well, bad news. That's not here. It's probably not coming, and we don't really know where interest rates are going to land or what is going on with the market. So during times like this, I can remember last time around, we had the 2008 great financial crisis, big subprime crisis, almost melted down the global financial system. All good. I was starting to invest in properties around that time, and I can remember as I got started as an agent, I would go around to networking groups, meet with clients, and it was really hard to get people interested in investing in real estate. We'd talk about how cheap everything was, how it was virtually impossible that you could do any wrong by buying anything at that point, which generally I don't recommend trying to time the market and buy low, sell high like that with the stock market mentality. But that was really the way everybody felt. People thought that after 3-4 years of bad declines in value, foreclosures, a lot of properties lost 30%, even 50% of their value. The general consensus with a lot of people was that the real estate is dead forever. It's never coming back. It's a bad investment. We were all duped into believing that real estate was a great way to build wealth from whoever was involved in the industry on the lead up and in the subprime boom. Well, as it turns out, sure enough, a couple years down the line, market turns around. We're talking kind of 2011, 2012, and then by 2013, 2014, we're in an aggressive seller's market. There's low inventory. Interest rates remained pretty low because we had to lower them a lot in response to the crisis. And really throughout that whole next decade, and then ending with the pandemic, which was its own unique set of circumstances, it was a raging bull market for real estate. So what's with that? We've talked about sentiment a lot in the other videos and how that affects the market. And so the big question I think that a lot of people are trying to wrestle with is exactly that question. Is real estate or whatever asset class you're looking at, is it dead forever? Do I need to shift my attention to some other investment type or work on some other business? Or are we looking at a cyclical change in the business of properties? So it certainly felt like it was going to be a long-term forever change back then. I know that's the temptation. Now we're 2 years into this downturn. It feels like, well, everything's just different. It's always going to be different. I don't think you can make money in real estate anymore. So I don't know, I'm going to get into cryptocurrency or something else, or pick a stock winner, and that's going to be my next thing. I just don't think real estate's going to be a good investment moving forward. Well, what you really need to be asking yourself is what you're seeing in the market a cyclical trend or a secular trend? And you've probably heard those terms before. Maybe you've read about it a little bit. It's kind of confusing, but the general difference between the two is a cyclical change or a cyclical trend is a trend that kind of goes in line with the business cycle. So interest rates, inflation, those sorts of things, the stock market, the general business cycle moves relatively predictably, although we can never really predict what's going to happen in the future. We sort of have these 10 to 12 year business cycles that are expansion and then downturn and then recovery and so on. You've all seen those charts, right? And the temptation is you'd like to believe that whatever's coming in the future is going to be better than the past, and you can play the cycle and make a whole bunch of money. Buy low, sell high, right? Well, The worry, though, is that what we're looking at is perhaps instead what we'd call a secular trend. And a secular trend is a much longer cycle. You could use the term secular trend to describe any kind of broader long-term change, whether it's in the economy or social changes, government, demographics, environmental changes, all that kind of stuff you could describe as a broad secular trend. A good example, economically speaking, would be, say, like looking back to the early 1980s. I think we've all seen those charts. We had really bad inflation in the 70s, and interest rates in the early 80s got up to 17, 18%, even 20%, depending on the type of loan that you were in, and then topped out, and as inflation came down, interest rates started to come down as well. We enjoyed over 3 decades of lower inflation, lower interest rates, much longer period to that trend. I would call that a secular trend. And that change had obviously ripple effects through the entire economy. You had tons of growth stocks, companies did really well. You had the boom and bust of the dot-com stocks back in the late 90s, early 2000s, which I would describe as cyclical. But then you've had all this money piling into basically growth assets, real estate, things that do well when money's cheap and debt's cheap. Bonds have not done very well for a long period because of that secular change. Now, the big question on everybody's mind today is, have we moved into a new secular trend as it pertains to interest rates, inflation, cap rates in the context of commercial real estate? And that's the worry, right? We've got inflation somewhat licked from where it was after the pandemic, but rates are remaining stubbornly high. The economy's still really healthy. We're not seeing interest rates come back down into the 4s, the 3s, the 2s. Cap rates have risen pretty dramatically in all commercial real estate asset classes, multifamily as well. And so where do we go from here? Are we looking at a period of decades from now where cap rates can be expected to slowly kind of, renormalize into the 6, 7, 8% range? Or are we looking at cyclical changes where as inflation continues to come down, interest rates are going to keep coming down on a more shorter time frame, and we're going to be able to take advantage of that? Big question, huge if. I can't pretend to know the answers myself, but thinking about this stuff is what can help you make sense of the investments that you're looking at, and maybe start to think about how you might apply some of those economic fundamentals to the buildings that you're looking at. Definitely these days, I would say that investing in apartments, whether it's apartments, office, retail, anything, all of a sudden income in place is way more important than it was. You can feel the change in the market when you're looking at these deals. I can remember looking at deals that were 14, 15. I think the last deal I bought in 2022, I bought for 16 times gross. So that's a super low cap rate. That's in the 3s, right? Managed to make it work because it was a great value add, so definitely a growth-focused investment. These days, very, very hard to sell a property with multiples that high. Very difficult to sell a property with cap rates that low. People want to buy on actuals and they want to buy for yield. So that same mindset we're kind of seeing trickle through the property markets as well as into the bond market. A lot of money is now in the bond market that wasn't in the bond market before interest rates got so high. People make great yield from treasuries, from corporate bonds, money markets. And so you hear all this stuff about when is that money piling back into risk assets. That's the big question that we should be asking. And I think that's how you're going to know where the puck is going when we start to think about the value trajectory as we come out of this downturn. I think that was maybe a lot of financial mumbo jumbo, so I'm not sure if any of that made any sense, but these are just some of the musings that I have as I'm walking the dog around the office here. So maybe give us a comment, let us know what you think below, and let's have a good discussion.